This is Nightly Business Report with Bill Griffith and Sue Herrera.
Trade talks loom and investors aren't sure what to expect just days before higher tariffs go into effect.
Basketball backlash. A single tweet has thrown the NBA into a geopolitical crisis with China threatening billions of dollars in a critical market.
Slowing down, why experts say autonomous vehicles are not yet ready for prime time, even as car companies increase their investments in that technology. Those stories and more tonight on Nightly Business Report for Monday, October 7th.
And we do bid you a good evening, everybody, and welcome. Stocks started this week searching for direction. The latest round of trade talks between the U.S. and China are going to be hanging over this market all week, just days before higher tariffs are scheduled to take effect. Investors are trying to gauge what, if anything, are going to come out of these talks. And so far, they're getting some mixed messages, and that caused the push and pull that we saw today, ending with the Dow down 95 points to 26,478. The Nasdaq was down 26. The S&P slid by 13. Kayla Tausche starts us off tonight from Washington.
Round 13 of U.S.-China trade talks kicked off in Washington today. Lower-level officials meeting to figure out a menu of items for cabinet-level negotiators and potentially President Trump to take up later this week. With tariffs escalating in days, a potential meeting between Trump and President Xi in weeks, and critical election primaries in months. Here's President Trump today.
I think that we just have to see what happens. I would much prefer a big deal, and I think that's what we're shooting for. Can something happen? I guess maybe. Who knows? But I think it's probably unlikely.
White House advisors are hedging their bets. Economic advisor Larry Kudlow, open-minded.
We are waiting for the Chinese offer. We are open to almost anything right now.
But White House trade advisor Peter Navarro told NPR today any deal would have to be comprehensive, with new laws to combat technology theft, something Chinese officials signaling they're unwilling to offer. People close to the talks note that's been a deal breaker for the White House in the past, but U.S. officials want to avoid any more self-inflicted economic wounds. Economist Mary Lovely says the U.S. will have a hard time completely rolling back tariffs now.
The president is going to get much less out of this than was advertised originally, and so he's going to have to say that he's going to keep some powder dry in case commitments are not made or in case we don't move forward.
The next round of tariffs will hit consumer electronics like iPhones and laptops, engines of U.S. innovation, perhaps giving an advantage to foreign competitors like Samsung, who don't assemble products in China, and driving up prices for those that are. For Nightly Business Report, I'm Kayla Tausche in Washington.
So what is the market hoping to hear from the trade meetings at the end of the week? We're joined by David Leibowitz. He's the global market strategist at J.P. Morgan Asset Management. David, welcome back. Nice to see you again.
Thanks for having me.
What does the market anticipate or want to hear at this juncture?
So I think that the market is operating under an assumption that eventually, at some point, we do get some sort of deal. I think in terms of what the market wants to see with respect to this week and the next couple of months is the tariffs that are on the cusp of going into effect, seeing that can get kicked, seeing no escalation in trade tensions beyond where things currently stand. I don't think the market is expecting this to go away, but I think kind of maintaining that 2 steps forward, 1 step back type of narrative that we've seen in play for the past almost 18 months is kind of what the market is currently pricing in.
There was a survey released today, David, of the economists that make up the National Association of Business Economics. And, you know, a majority of them said they feel like the U.S. could dip into recession next year, largely because of the tariff situation, the trade war. So our question is, what would keep us out of recession? Prioritize some of the issues that they are going to be negotiating this week. I mean, is it something to do with the consumer? Is it manufacturing is already in recession at this point? Is there something they could do to pull that out at this point? What do you think?
I think manufacturing is in a bit of a tough spot. And what happens with manufacturing activity, not just in the U.S., but around the world going forward, is going to be beholden to how trade talks develop. In terms of our view on where the U.S. economy is headed, headed, it really all comes down to the consumer. Manufacturing goes through mini cycles every 18 to 24 months. We've seen a couple of them over the course of this expansion. The consumer has been able to offset that weakness. During prior episodes, the consumer is actively offsetting that weakness during the current episode. But the question that you need to ask yourself is, we look at last week's job report, we see the pace of job growth slowing down. The consumer isn't headed off of a cliff, but consumption is obviously a function of what goes on in the labor market, and you're seeing companies begin to pull back a little bit. And so that's something that we need to keep an eye on as we gauge the longevity of this expansion.
And very quickly, if these new tariffs do go in, they are going to hit a lot of consumer electronic products.
Yes.
Which could, I would assume, have a dampening effect.
Absolutely, and I think that's why this final round of tariffs is so scary. Up until this point, people don't buy washing machines every year for the most part, but they do buy phones every year. And so we need to think about, what is in this set, and it's definitely more relevant to the way that the consumer spends their money.
David, thank you so much, as always.
Thanks for having me.
David Leibovitz with JP Morgan Asset Management.
And as we've been reporting for months now, farmers here in the U.S. have been hit with a 1-2 punch, the trade wars and bad weather. And now that, in turn, is hitting demand for farm equipment. We sent Frank Holland to East Moline, Illinois, to see how that industry is faring right now.
Farming is cyclical. A time to plant, a time to harvest, and a time to buy new equipment.
I'm being very conservative about large equipment purchases.
Phil Four is a sixth-generation farmer.
It was planted fairly early May, so there's a few beans in those pods.
He's among many farmers in the Quad Cities area of Illinois and Iowa who say they've been directly impacted this season by floods and rain in the Midwest, as well as the ongoing trade war, reducing demand for soybeans.
The farmer in the U.S. is obviously in a worse position than they were a few years back to be buying combines and tractors. I'm just trying to take a wait-and-see attitude, maintain the old equipment, and then if times improve, we'll roll into some newer tractors or combines.
We've backed off on any capital purchases of anything very high dollar at all. We're going to postpone anything in the future for probably a full year, possibly 2 years out, and just maintain the line that we now have. The income just isn't there to justify a new high dollar purchase.
Major manufacturers seeing the uncertainty of farmers hitting their bottom line. Farming equipment shipments are down 18% year to date from a peak in 2014. John Deere will lay off 160 workers later this month and in November after reporting a 6% decline in sales for its agriculture division last quarter. AGCO reporting sales of tractors are down 2%, combines down 3% in the first half of the year. John Deere is the region's largest employer, and people who live here say they have a mixed outlook on downturns and layoffs.
I believe all the farming industry runs in cycles. I think that, we have layoffs and shutdowns for a while, but it seems like they always call people back.
It hurts everybody. It's just like a downfall, machinery costs go up and people lose their jobs, and it's really bad.
With trade talks resuming on Thursday, farmers say they're hoping for a new deal that will give them the confidence to buy new equipment. Here in East Moline, Illinois, Frank Holland, Nightly Business Report.
Meanwhile, Americans slowed their pace of borrowing slightly in August. According to the Federal Reserve, credit card debt actually fell. But auto and student loans saw their biggest jump in 3 years. Economists, of course, are watching the consumer closely for any signs that households may be pulling back on their spending. As you know, the consumer has been the one bright spot for the economy so far this year.
And the health of the consumer is key to the housing market. But a funny thing is happening. A new survey shows consumer confidence in housing is weakening, just as homes are becoming more affordable. Diana Olick explains the disconnect.
Lower mortgage rates are making home buying more affordable, but concerns about personal financing are eating into overall confidence in housing. Consumer sentiment in housing fell in September from its August high, according to a monthly survey from Fannie Mae. Why? Well, because more Americans said they are concerned about losing their jobs. That was the second straight month that component of the survey rose. This as mortgage rates now sit at the lowest level in over a month and are significantly lower than they were a year ago. The average rate on the 30-year fixed mortgage is around 3.64%, That means that about 21% of the national median income is required to make the monthly principal and interest payments on the average priced home. This is the second best affordability rate in nearly 2 years. It also adds about $46,000 in purchasing power. That's boosting home sales and mortgage refinances as current homeowners take advantage of potential savings.
I'd say most of the folks out there today should think about getting a refinance because these rates are now at historic lows. And in fact, we're actually seeing the purchase market pick up. September was a very, very strong month for us from a purchase perspective, and I think interest rates help that as well.
So far, lower rates seem to be outweighing weaker confidence, fueling the fall housing market and strengthening home values. But if home prices overheat again and rates turn higher, the scale could easily tip in the other direction. For Nightly Business Report, I'm Diana Olick in Washington.
Time to take a look at some of today's upgrades and downgrades. We begin with shares of Uber. They were upgraded to buy from neutral at Citi, with the analysts saying the company's third quarter results may help investor sentiment. Those results will be released next month. Price target $45. The stock rose 2% today to $30.37. E-Trade was upgraded to buy from neutral at UBS. The analyst says that E-Trade has the most value of any of the online brokerages. Price target $41. That stock gained 2% to $37.22.
Wendy's was downgraded to market perform from outperform at Cowen. The analyst says the company's push into breakfast could be costly. The price target is $20. The stock finished just about at that level at $20.11. Carnival Cruise Line was downgraded to hold from buy at HSBC. The analyst cites the potential for weaker bookings in 2020. The price target $43. The stock fell a fraction to $40.91.
Still ahead, a foul has been called on the NBA in China, and now the league is in crisis mode.
General Electric is freezing its pension plan for 20,000 employees. The decision is designed to reduce GE's pension deficit and shore up its balance sheet. About 100,000 former GE employees who haven't started receiving pension benefits will be offered a limited time lump sum payment. No changes will be made for retired employees. The stock was down a fraction in today's trading session.
General Motors is temporarily laying off another 415 workers, this time in Mexico, due to the strike here in the U.S. The company had to halt production at a V8 engine and transmission plant in Mexico because of a shortage of parts. Today's layoffs are in addition to the 6,000 temporary layoffs that were announced last week. Meantime, over the weekend, United Auto Workers officials said the talks with the company had taken a turn for the worse. The strike is now in its fourth week.
Many agree that the consumer is in good shape, and that bodes well for restaurant stocks, which begin reporting earnings in the coming days. But the consumer isn't the only thing driving business in that industry. Kate Rogers takes a look at the sector and what to watch when earnings are released.
Is it time for investors to dine on restaurant stocks? The next few weeks could hold the answer. It used to be that the strength of the consumer would make or break the quarter, but not anymore. The industry's gone through a big transformation that includes the growth of delivery services. In fact, Americans spent some $10 billion on third-party delivery last year alone. Mentions of these companies by major restaurant players have been on the rise in recent years. It's been a big boost to business for brands like Chipotle and McDonald's as they expand their reach. Meanwhile, Domino's has admitted it's being pressured by increased competition from these companies.
Well, if you look at the trends over the last roughly 12 to 18 months or so, off-premise sales have been the biggest driver of any sales growth for the industry. And a principal part of that is delivery. Domino's certainly has felt the surge in third-party delivery providers.
Then there's the restaurant itself. Upgrades in new technology, things like kiosks and mobile order and pay, are attracting new customers. Both Starbucks and Chipotle have continued to emphasize mobile offerings and have seen loyalty program enrollments increase as a result.
And if you look at where the real success has been in sales growth related to technology, Certainly McDonald's is one of the largest. Chipotle has been very, very successful. Starbucks has been very successful. All of those companies are, I think, great examples within the industry where economies of size and scale and the ability to invest in the business is really making a difference in their sales trends versus a lot of the smaller operators.
And finally, analysts will be looking out to hear how value is playing among consumers as recession chatter continues, and how new menu items like plant-based meat at places like Burger King and Dunkin' are performing. For Nightly Business Report, I'm Kate Rogers.
Harley-Davidson's e-bike may be stuck in neutral, and that's where we begin tonight's market focus. Reuters says that the motorcycle company is seeing weak demand for its new line of electric bikes that are called Livewire, due to a nearly $30,000 price tag and a lack of interest from younger and more environmentally friendly riders. Harley shares fell about 3.5% on that news to 34.11. Livongo Health has won a government contract allowing that company's diabetes management program to now be offered to federal employees who either have type 1 or type 2 diabetes. Livongo says that the contract will increase its revenue up to $60 million and bring it up to 45,000 new customers over the next few years. And shares jumped big time today, up 18% to $20.50.
ConocoPhillips is hiking its dividend nearly 40% to 42 cents per share. The energy company also announced a $3 billion share buyback program for next year. Conoco rose about 2% to $54.60. Dick's Sporting Goods is looking to hire up to 8,000 seasonal workers for the upcoming holiday season. Next week, the retailer will be hosting its second annual National Signing Day. In an effort to help fill those seasonal positions, Dick's hired 5,000 employees at that job event last year. Shares were basically off more than 2% today to finish at $37.94. The NBA finds itself in the middle of a political crisis. One of the teams most popular with fans in China now finds itself in hot water, all because of one tweet. And as Eric Chemi reports, there are billions of dollars at stake for the league, which has spent years growing a massive audience in that country.
Houston Rockets general manager Daryl Morey tweeting on Friday night an image saying, "Fight for freedom, stand with Hong Kong." That led to an immense backlash from the Chinese government and some of the NBA's major Chinese partners. The NBA issuing its own press release calling Morey's tweet regrettable, while Rockets owner Tillman Fertitta distanced himself from Morey's message, saying the Rockets are not a political organization, nor does Morey speak for the team. The fallout has put the NBA's relationship with China on thin ice, a relationship that the league has been carefully nurturing for decades. Today, Forbes says the NBA's China division is worth more than $4 billion, or $133 million per team. While the league has allowed players and coaches to be vocal on domestic political issues, it has taken a different approach with China. The league has boasted about the 300 million basketball players in China and the 500 million people who tuned into an NBA game last year. Over 20 million people watched Game 6 of the NBA Finals. The league's media deal with China's Tencent is worth over $1.5 billion. Tencent has already said it would not show Rockets games. That comes as a slew of other Chinese sponsors have cut ties with the Rockets. That is a twist because the Rockets are perhaps the most popular NBA team in China due to Yao Ming, who played his entire NBA career for the Rockets. Yao is now the chairman of the Chinese Basketball Association, which has cut ties with the Rockets as well. The Los Angeles Lakers and Brooklyn Nets will play in China this week as part of the league's preseason global tour. Nets owner Joe Tsai is a co-founder of Alibaba and issued a lengthy statement against Morey, connecting it to a history of foreign interference in China and the threats to its territorial integrity and sovereignty. At stake is a business that has been notching double-digit growth in China since 2008, and internet viewership of NBA games on Tencent has tripled in just 4 years. For Nightly Business Report, I'm Eric Chemi.
So with billions of dollars at stake for the NBA in China, the league clearly is in damage control right now. And joining us tonight with some thoughts on that, Dean Crutchfield's back with us. He's CEO of the crisis management firm Crutchfield and Partners. Dean, good to see you again. Welcome back.
Good to see you. Thank you very much.
Commissioner Adam Silver is going to be in China as part of those exhibition games. He's going to hold a news conference. What do you think he should say?
Well, I think he's got to be very direct about his message. You know, he's got to be, yes, apologetic to China for maybe the upset it's caused them, but I think he also has to defend American principles. We have to show leadership. That's what makes America great. We can't kowtow to China, but there's billions of dollars, as we know, at stake here. So it's a very sensitive issue. You know, he's basically going to be skipping through the raindrops, having to manage it very delicately. But what he does need to do is respond boldly. Now, what can that mean? It could mean different things, but most importantly, it has to be done in bold step forward, and that has to be done with the view that America is good.
But it is a fine line, is it not? Because the league is getting criticism from players and from politicians about kowtowing to China. So
Yep.
how does he walk that fine line? How does the league and the players, how do they walk that line?
Well, I mean, what you need to do is look at, what's the best message to put forward. Now, marketing is a great way of unifying people. And, what's needed in this crisis right now is going to be a lot of marketing coming out over the next days and weeks, because that can unify. Brands basically are meant to bring people together, but sport is meant to unify points of view. And this is about a sport. So they can use the sport as a platform, as a mantle to communicate a message of how to unite people's points of view around celebrating sport. So basically what he needs to do is defend the position they took. He needs to deny that there was anything about sovereignty or any imposition towards China, and he needs to deflect the responsibility of the situation to Daryl Morey, who made the statement and did the tweet. That's what they need to do. So defend what they've said, delay the ultimate response, deflect the responsibility to Morey, and basically defend their position. Absolutely critical.
Along those lines, should Rockets owner Tillman Fertitta fire the general manager who tweeted that?
I think, look, if this was another business, he would be fired for this. This is a breach of conduct. This is a situation where you've made a statement that you should have known, shouldn't have been sent. You didn't seek permission. In a corporation, this is a fireable offense. I think the ultimate thing they need to do is they have to get rid of Morey to show that they mean business.
It's going to be interesting to see what Adam Silver does, in fact, say this week. Dean Crutchfield with Crutchfield and Partners. Again, thanks for joining us tonight, Dean.
Okay, thank you.
Coming up, want to let your car do the driving? Experts say not so fast.
About 1/4 of healthcare spending here in the U.S. can be classified as wasteful. That's according to a new study from Humana published in the Journal of the American Medical Association. Complex administrative structure accounted for most of the waste, followed by things like failure of care delivery, failure of care coordination, and overtreatment. The study estimates that roughly half of all wasteful healthcare spending could be avoided.
While Elon Musk and others are promising the arrival of self-driving cars within the next couple of years, there's a growing number of executives in the auto and tech industries who are pumping the brakes on those expectations. They say it will likely be many years before you see driverless cars zipping around your city. Phil LeBeau has more.
From autonomous minivans in Arizona to self-driving cars on the streets of San Francisco, the auto and tech industries are getting close to putting driverless cars out on the road in large numbers. But experts say, slow down.
They're not ready for prime time yet. There's a lot of development that has to take place.
Dr. Mark Rosekind and the team at Zoox are developing an autonomous vehicle. But at a safety summit in California focused on self-driving vehicles, he and others admit the technology still has a ways to go.
We're still very much at the learn, put it out there, understand how people are going to use the technology, and then build a business around that.
Urmson's company, Aurora, which develops autonomous vehicle technology, says the potential benefits for freight companies, meal or package delivery firms, even rideshare operators is enormous but still unproven. That's not stopping Tesla CEO Elon Musk from pushing his company's autopilot technology as the next step in letting the car do the driving. But fender benders and close calls with driverless Teslas has some wondering if the public is ready to accept this move.
The public's going to have to trust these. If we don't have new safety metrics, transparency, and experience with people, we're just not going to see the widespread adoption that's going to make this truly transformative.
Which brings us back to Chris Urmson. In 2015, as a leader of Google's self-driving car project, he talked about the future of autonomous cars.
Our team's goal is that my 12-year-old son won't have to get his driver's license because he'll be able to get places in cars like this.
4 years later, Urmson says this.
He turned 16 about 2 weeks ago, and so he can get his driver's license. He hasn't yet gone to go get it. So we're, I think when we looked forward from 5 years ago about this technology, I think perhaps we're a little more optimistic about how quickly we cover the ground.
The bottom line, the technology driving autonomous vehicles is coming along quickly. But most in the industry are now more realistic about predicting when we will see large numbers of self-driving vehicles out on the road. In fact, many believe that won't happen until well into the next decade. Phil LeBeau, Nightly Business Report, Chicago.
And finally tonight, The Joker had the last laugh over the weekend. The controversial motion picture had the biggest October opening of all time, raking in $96 million at the domestic box office. That figure beats the previous record held by the Spider-Man spin-off Venom. And for the Warner Brothers Studios, it was its biggest debut in 2 years.
Before we go, here's a look at the day's final numbers on Wall Street. The Dow fell 95 points. NASDAQ was down 26. S&P 500 slid 13. That is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.